folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a quick market update, all focused on tariffs. Yesterday, the administration came out during a press conference and basically said that the tariffs on Canada and Mexico were going to go into effect as of today, which they did. That's a 25% tariff on all goods coming out of Mexico, a 25% tariff on most goods coming in from Canada, only a 10% tariff on energy imported. And then they also levied an additional 10% tariff on China. This caught the market a little bit by surprise. I think there were a number of observers over the weekend that were feeling that given the administration's recent comments on border security and the improvements in sort of illegal immigration and drug trafficking, et cetera, that maybe they would not feel the need. Maybe they were trying to communicate that they wouldn't need to put tariffs into place on Canada and Mexico. So the market sort of has traded down reasonably swiftly, having its sort of worst day of the year yesterday in response to the tariffs. Just to give everybody a recap of kind of where markets are, the S&P 500 is down about 2% for the year in total. And that's not great, but it's certainly not as bad as some other pockets of the market. So if we look at things like the Russell 2000, which is sort of small and mid-cap focused, that's down about 8% year to date. If we look at the Mag 7, so the really super large cap stocks, those are down almost 10.5% year to date. And then if we look at Bitcoin, that's down about 12% year to date. So not exactly behaving as a safe haven asset. Meanwhile, if you start to look at, bonds, which are a traditional flight to safety type asset, they're trending up about 2.5% year to date. Actually, the world's best performing asset class, or at least among the ones that we're listing, is actually international equities, up about 5.5% year to date, for reasons that we'll talk about a little bit later. So, as we mentioned on the policy side, these tariffs went into place here domestically, and there has been a swift sort of retaliation announced from both China and Canada. Canada announcing some targeted tariffs around U.S. agricultural imports, along with some considerations about maybe stopping the sale of electricity to the United States, which could affect those in the Northeast, as well as potentially stopping nickel imports into the United States. And then the Chinese announcing some tariffs targeted once again at U.S. agriculture. Meanwhile, Mexico is going to get back to us. I don't think they were expecting this. And so their trade response isn't scheduled to get to us until the weekend. If you look at the net impact of all of that, as we've said previously, total inflationary impact is about 0.7%, so 0.7%, 0.7 of 1 percentage point, which will complicate matters for the Fed as they start to see those price increases roll through. There's an open question about what they're going to do there. And then if you look at just impact to GDP, estimates range anywhere from a reduction in U.S. economic growth of anywhere from 30 basis points, so 0.3%, all the way up to a full percentage point. And depending on how much those reciprocal tariffs from foreign countries go into place, we'd probably expect to see something towards the higher end of that range. So, markets obviously not really happy with this idea of slowing growth here domestically, but also kind of internationally. As I mentioned, this does complicate matters a little bit for the Fed. One of the things that I think they learned coming out of COVID was even if I can explain why prices are going up, I probably should still raise interest rates to combat that inflation. And so we will just have to see. I'm presuming we're going to hear from Chairman Powell at the end of this week on Friday. I presume that questions around how the Fed will think about responding to tariffs will be at the top of the list for reporters to ask him. How will they respond to inflation that might be coming from tariffs? Will they meet that with higher interest rates, or will they just let that inflation slide? Obviously, remember, this is the same Fed board that got into trouble with letting inflation slide back during the COVID supply chain days. So that may color their view. Meanwhile, This idea of slowing global growth is obviously spooking equity markets, and that's sending a lot of money to transition into fixed income. So we've seen the rates on the 10-year Treasury drop all the way down to about 4.15%, which is a meaningful reduction in overall 10-year interest rates. And the forward curve for Treasuries implies that the Fed would actually start to cut rates by the summer and cut them pretty swiftly in the back half of the year. Now, in my mind, that is not a bullish signal because if you think about what the Fed needs to be seeing from an unemployment and economic growth standpoint to be in a position to start cutting rates as soon as July, I don't think anybody should confuse this as yay, we won the battle versus inflation by just gradually slowing down growth. No, those rate curve movements are actually much more of a flight towards safety. There's more of a fear element in the marketplace that's leading to that lower rate curve on the outside. And interestingly enough, this lower rate picture in the United States, as investors sort of flee to safety, is offset by a somewhat higher interest rate picture in Europe and elsewhere around the globe, which is actually causing the dollar to weaken. So we've seen a much lower U.S. dollar versus both the euro and versus some Asian currencies. And that's going to kind of has a dual effect. One, it makes the tariffs that much more impactful because now you're buying more expensive goods with a less valuable dollar. But then the second thing that it does in terms of sort of international markets is it does make international markets more attractive relative to the U.S. Because if I have goods that are denominated in euros or equities that are denominated in euros and I'm bringing them back to the United States, weaker dollar actually means higher stock prices. And that's one of the reasons why you've seen international markets outperform this year is that weaker dollar that's coming through as a result of all of this. Now, with all of that said, it sounds a little scary out there, and I would say that the fear factor has certainly ratcheted itself up a notch. However, I would just note that periods of volatility in the market are normal. We see sell-offs of 5% on average about 3.5 times a year. We see sell-offs of 10% on average about 1.1 times per year. And corrections of 15% happen about every other year. And bear markets, corrections of down 20% happen almost every third year. That doesn't mean that we're headed for any one of those things in particular. However, it does mean that markets generally go up over time, and they go up in spite of these bumps in the road that we feel. In fact, the bumps in the road are actually pretty normal. And I like to remind people of that because, when we get years like 23 and 24, which are very low volatility, high return years, and then we get into something like what we've seen in the beginning of 2025, everybody kind of freaks out a little bit because it's very different than what they've experienced in the past. I would just note that 2025 is actually the expectation in terms of overall volatility, not the exception. The exceptional years are actually 23 and 24. And so just be aware that this is something that the markets normally go through. I know it feels a little scary. It in particular feels a little scary because we haven't been scared in a while. But just note that, these types of market movements are normal. And we do have a playbook for this type of stuff, right? Like, this is why you diversify in the first place. This is why you hold things like fixed income in your portfolio or international stocks in your portfolio because they help to cushion the blow when, the S&P 500 isn't necessarily doing all that well. This is the time of year where we look at rebalancing, right? And look at, whether or not the ratios between those various asset classes are kind of in line with model. And this is also a time of year to keep an eye on your sort of very appreciated assets, for investors that maybe have a large percentage of their overall holdings in a particular stock or a particular fund. particularly for non-qualified accounts. Seeing these types of price movements lower can generate opportunities to rebalance and can generate opportunities to potentially diversify away with less tax consequences. Last but not least, this also creates, for some investors, the opportunity to do some tax loss harvesting, although we're not quite there yet in terms of the amount that the market has actually dropped. But that is the playbook for this type of volatility, and it's a playbook that I encourage everybody to follow. So with that, as always, if you have any questions, please feel free to reach out to either myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.